The Hang Seng China Enterprises Index ended its latest volatile session with a 1.8% loss, closing at its lowest since November 2005. Chinese government has had another election for a new premier, who is the same old face of Xi Jinping. Today, we will look at how this third term for Xi Jinping will affect the markets. Whether the fall of the Chinese stock market is going to have a quick turnaround. The stock prices have fallen down quite steeply in Hang Seng. A good investor will tell you that this is an opportunity to make great gains by buying at a low. We answer the question: is there an opportunity to make incredible gains in Hang Seng? Whether the Chinese will make a recovery? If so, how can you make capital gains by riding the wave? China has become the center of attention. China's stock market has fallen the most since 2008. Chinese stocks have dropped the most since 2008. If you haven't heard, China's stock market has had a dreadful year, one of the worst ever. In 2022, the Hang Seng Index has been entirely crushed. Spooling has increased by around 50% since the beginning of the year. Michael Burry, one of the most well-known value investors, has taken note. The Hang Seng Index is regarded as the standard stock index for Hong Kong's equities markets, and the index's 60 or so constituent companies account for roughly 60% of the overall market capitalization of the Hong Kong Stock Exchange. The index is now trading at an earnings-to-price ratio of 9.1, which is 25% lower than the 3-year average price-to-earnings ratio of 12.4. Meanwhile, revenue has increased by 7% per year, while earnings have remained relatively unchanged. This could be attributable to a variety of factors, including increased operating expenses or more capex to revenue at that 7% annual rate. The index is now trading at its lowest level against the S&P 500 since 2001. As a result of learning how everything played out at China's Communist Party Congress, foreign investors have rushed to offload shares. Specifically, what happened with President Xi's appointments to the Politburo Standing Committee. If you're not aware, the Chinese Communist Party is the country's highest ruling body. It functions as the highest power center in Chinese politics. It is made up of a group of 6 people who have the final say on policy ideas. This is a concern because these new members, or at least the way many of these big-time investors see them, are all loyalists. Analysts say that if this group of 6 does not object, President Xi will simply continue to adopt tighter and stricter regulations, such as nationalizing enterprises and maintaining their COVID-0 policy, things that are often detrimental to economic progress. We can observe how trading fell and then recovered the next day slightly. However, the trajectory remains downward for the time being. Most investors believe China's economy is currently overly risky. Now President Xi and the Chinese government may have hoped that by announcing these strong GDP figures for Q3, they could shore up the markets. However, the markets, on the other hand, fully sold off heavily. Consider how much the CCP despises this. It's the one thing they genuinely have no control over. It most likely drove them insane. Their GDP figures now show that their economy grew quicker than projected. But do the investors believe it? With the tremendous disruptions in productivity that we saw in key Chinese cities during Q3, how could that be? For instance, the city of Chengdu was evacuated in September after only a few COVID cases were discovered. It has a population of 21 billion people. The government then extended the closure for another week, just as it was about to finish. That isn't the only one. There are cities following cities like this, totaling 49 Chinese cities with lockdowns, affecting an estimated 291 million people. That equates to around 20% of China's entire population and 24.5% of the country's GDP. Michael Burry, a great investor, has now spotted this significant sell-off. If you don't know who he is, he's a short-term value investor seeking transactions with high potential returns. He is well known for identifying bargains that include bug returns. He demonstrated his abilities by becoming one of just a few investors to correctly foresee and profit from the 2008 housing meltdown. He planned ahead of time and ended up making a total of $700 million for his fund. He accomplished this by investing in credit default swaps to profit from the historic spike in mortgage defaults that followed the Great Recession. Anyway, he highlighted Hang Seng's decline on Twitter by adding, "Meet the new boss, the same as the last boss." The Hang Seng recently returned to levels last seen in 1997, 25 years ago. During that time, however, GDP increased 18 times. In 1997, the valuation was 20 times earnings and 10 times EV divided by sales. 3 times tangible book, now 7 to 1 to 1. Take note that 3 of the last 4 premiers serve 3 terms. Michael Burry makes an excellent point. Essentially, Hang Seng is grossly undervalued. Over the previous 20 years, the Chinese economy has skyrocketed, with GDP increasing 18 times from where it was. However, the companies that comprise this index are now valued at 1997 levels. Now, if you have a lot of cash that you want to deploy and you are in a position to invest that wealth over time, then there's Hang Seng, which may be one of those once-in-a-lifetime purchasing opportunities. We believe it is only at these levels because of the current geopolitical environment, the unusual pandemic crisis, and China's COVID-0 strategy. If you can weigh that out and buy now, it may be the same as getting into the S&P 500 or Dow Jones at the bottom of the Great Recession. It does come with its own set of hazards, so be prepared and do your homework before investing. If you're looking for new opportunities, this could be a good one. It could be a wonderful opportunity, especially given that the US markets still have a long way to fall and are far too overpriced. As a value investor, no one would consider the S&P 500 to be a decent buy right now. There are hazards to going along with China like this, and we'll go over some of the ones that Michael Burry mentioned. It's not just Burry who's talking about this. Other heavyweights, like JP Morgan's Marco Kolanovic, see it as an opportunity to scoop up shares. He believes that current levels are divorced from fundamentals and that positive growth will resume after COVID-0 expires. Then he believes the entire market is about to collapse. Also, Allianz Global investors generally stated that they expect COVID-0 to terminate in the near future. They are particularly interested in employment in China's tourism and leisure sectors. Many specialists now advise Western investors to avoid investing in Chinese companies. That is most likely sound advice, especially for novice investors. However, as previously stated, if somebody has the capital to invest and is seeking genuine bargains, there could be one area that is currently actually undervalued. Now, China may still have a long way to go before it is free of significant difficulties. Their advanced semiconductor sector has now been completely wiped off. After the US government imposed export bans on all advanced semiconductor materials last week, the semiconductor market provided 263 billion yuan in 2020, which is not a tiny market. Furthermore, China's housing industry, which accounts for 30% of the Chinese GDP, is in crisis. Over there, they're dealing with a financial crisis that has the potential to spiral out of hand, and home buyers are still refusing to pay their mortgages. Lenders are going bankrupt, and home builders are pleading with Beijing to assist them. These property developers and home builders are now unable to complete these large projects that they began without the funds from the house buyer's mortgage. The Chinese property market as a whole is insane. It is grossly inflated, and the Chinese people are fed up with it. It is not as terrible in the United States as it is in China, but it is similar to how home buyers are currently uninterested in the concept of purchasing a home. The Chinese government isn't taking that lying down. Instead, they're encouraging everyone to keep buying houses, telling existing homeowners to buy a second, third, or even fourth property to compensate for the housing sector's lack of demand. Although it may appear to be a joke at the moment, the government has seriously promoted this agenda. The chances of it functioning are as slim as the knowledge. They are concerned for this reason. They are concerned about the lack of a thriving housing market. Their economy will collapse, and the People's Bank of China, plainly seeing the writing on the wall, is attempting to shore up its economy by stabilizing the yuan, which is at its weakest since the global financial crisis. And unlike the bulk of the Western world, they are continuing with quantitative easing. indicating that they clearly perceive difficulties in their economy and are attempting to assist it in recovery. Nonetheless, if you are serious and want to try to invest in China, we would simply advise you to exercise caution because everything is different over there. The markets are distinct. The exchanges are distinct. The rules are not the same. So before you begin, conduct thorough research to ensure that you understand exactly what you are doing. Remember, this is not financial advice from a professional. Remember that investors like Michael Burry have a large crew that does research tailored to the growth of their fund. You must make sure to understand your needs and research in that manner. So do let us know which topic we should cover next. If you enjoyed the content, give us a like, and please subscribe to keep up with more. See you at the next one. Bye.